Good morning, everybody. Thank you to everybody that's joining us today. Just as a point of housekeeping, if you have any questions throughout the discussion, then please feel free to raise them in the Q&A section. I'll field these as we're going through the discussion and look to cover as many as the key questions that we're looking for as possible. So please do feel free to ask. For those of you that don't know me, I'm Hubert Colvin. I'm one of the partners at Pauling & Co, which is the executive search arm of the cybersecurity skills business Adeptus Group. I head up all of our executive search operations for leadership hires and cybersecurity across Europe. And I'm extremely grateful to be joined today by Craig Dunn, Dr. Rachel Ann Carter, and Patrick MacGloin to discuss the topic of cyber insurance. So we decided to run this webinar on cyber insurance, really following a previous discussion that we had around the ransomware threat. And within that conversation, the point was raised around cyber insurance and what that should or shouldn't be covering. And following that event, we received a few requests to cover more on the cyber insurance piece as a whole. It's clear that cyber insurance as a market and as an industry has grown a lot over the past few years. More companies are looking for it, either as a transfer of risk, to protect balance sheets in the event of breaches, even just to be looking to be doing the right thing, or because we're starting to see some supply chains and service level agreements starting to demand it as well. And with that, of course, more insurance firms are bringing out products to offer the coverage, but ultimately, will it pay? Today, hopefully, we'll consider what cybersecurity insurance is all about, its role within a business, what companies should be considering, and some of the challenges facing the industry as it evolves. So Rachel, Patrick, Craig, thank you all for taking the time today. Before we dive into the discussions, if I could just ask each of you to give a brief intro to yourselves and a few comments on the topic from your perspective. Craig, if we might launch off with yourself.
Yeah, so I'm currently the head for cyber for Hiscox Europe. So I'm responsible for all of their cyber insurance products throughout the continent and Ireland. So in that role, I look after things like what does the aggregation look like and the systemic risk, as well as what we should be charging, what level of security we should demand of our clients, and ultimately what we should be covering as well in the policy wordings.
Thank you, Craig. Rachel.
Thank you, Hubert. So at the moment, I have two different roles. So I am the Director for Cyber Insurance at the Geneva Association. For those that aren't aware of the Geneva Association, we represent the CEOs of the largest insurers and reinsurers, and I head up all industry initiatives in cyber to help, inform the industry better and to collaborate on all different aspects of cyber. My secondary role to that is I also own a consulting company, Carter Insurance Innovations Limited, which deals with strategy, product, and innovation. Just as by way of background, I did come from the London market prior to my current role, so within an underwriting and/or market-facing innovation role in the cyber sphere.
Thank you. Patrick.
Hubert, thanks very much, and great to be here. Wonderful to be on with two great panelists as well. So Paddy MacGloin, I'm a practitioner. So I've been dealing with what we call now cyber for the last 20 years, firstly for UK government and then lastly as a consultant. And really, there's two areas that I kind of work in. Firstly, as a practitioner, as an independent advisor, I do a lot in what I call the independent breach coaching. So this is where it really hits the fan and somebody's had some kind of breach, and usually the insurer is called in. My role there is often to help mediate with insurers, but also to be looking at some of the downstream risks in and around. So sometimes that might include, for example, assisting with some of the ransomware negotiations, not paying them, nor would we ever advocate that. I'm sure that'll be a topic for later. But just helping clients think through, you know, the strategy, whether to buy time or think through issues, as well as marshalling the response activities, a recovery, and then some of the downstream return to operations. So that's part one. I also get involved quite a lot post breach as well. So this is typically where you go into an investigation, whether for loss adjusters on the insurance side, or perhaps there's putative litigation or arbitration coming down the track. And I'm a qualified expert witness in that space. And then lastly, as far as insurance is concerned, I do help a couple of entities that are looking at new insurance products. I know lots of people are talking about it, but it's actually shaping on some very specific lines as to what that looks like. Probably worthwhile mentioning as well, other than being a practitioner, I do support a couple of professional bodies. So firstly, I'm a fellow and board member at something called CSEC, the Chartered Institute for Information Security, where I run the innovation program, which is talking about big things like cyber insurance and what that means for capital markets, which I'm sure we're going to get into the fun and games of what regulators think and liquidity behind insurance. And then secondly, much more again from a practitioner's side, on the UK College of Policing, I actually sit on their standards boards for cyber and digital investigations. That's me.
Perfect. Thank you all. So, so to dive straight into the conversation and starting at the high level end of things. So first off, and Craig, if I might throw this over to you. I mean, what in a snapshot is cyber insurance, and how does it differ from what the standard business policies are that companies are taking out?
Yeah. So I think most of the other policies that a business might take out, like professional indemnity, are more just risk transfer instruments. And I think if you are a smaller entity in particular, cyber insurance is different because it provides all these services alongside of that risk transfer mechanism. So it provides you with the help and the aid that you need, as Patrick already laid out, of when an incident occurs, we help to get you back up and running as quickly as possible to mitigate the losses that you might suffer. And I think that's the really key component of cyber insurance that doesn't necessarily exist in other lines, when it only really kicks in when somebody sues you.
And who should be taking out cyber insurance? Who is it relevant for?
Yeah, I think anybody basically with any sort of dependence on their IT systems, which is, again, most companies nowadays. Plus, if you're holding any sensitive data, then you have an exposure, and you should probably be thinking at least about cyber insurance.
Okay, and from more of a practitioner's point of view then, Paddy, within the businesses, who within a company is the individual that's owning cyber insurance in most events?
Oh my goodness, what a question. I think you will find this varies so significantly. There's not an easy answer. I think there's a couple of things that we can say. Firstly, just by way of anecdote, dealing recently with one of the world's biggest petrochemical and heavy industries entity, a similar question got asked, actually. And it was asked to their global CRO, so Chief Risk Officer, and their global CISO, or CISO equivalent, actually. And there was convoluted views as to actually who owned the insurance policies, who's maintaining them, what do they actually cover? And that's with what one might see as a large, quite mature entity. Clearly global, it's federated, multiple different types of policies. I'm sure we're going to talk a little bit in a moment about standalone versus silent cyber. But there's an example of a well sort of established entity who really for almost 3 decades has had cyber insurance of one kind or another. And the level of confusion as to actually who owns that. I think when you go down a level from these sort of bigger organizations, perhaps those that are slightly more agile, perhaps slightly smaller to actually manage, the situation gets a bit clearer, particularly in the SME space, though there are different types of challenges, and perhaps we'll touch on them later. What's very, very clear, cyber insurance has been around really for about 3 decades. I think it was around about 2020, there was a very famous guy called Bruce Schneier who said, the information security industry will be run in the future by the insurance industry. Well, we'll see if that's going to come true or not. I don't think it's quite there yet. But the point is, it's been going for a while. And I think as it's been we'll talk about how it might have changed, I'm sure. But what's quite clear over the last couple of years, with the focus on data and technology as being an operational necessity for all organizations, we're all digital now. the insurance and cyber insurance as a standalone class is moving much more towards the operational resilience sort of space, the CRO space, and less towards CISO. That's huge generalization. But because there's value at risk, i.e. numbers associated with it, and because of, firstly, the impact, so the severity of impacts and their frequency, how often things are happening, cyber events, let's be absolutely clear. This means it's a material risk. So responsibility, I see, from a practitioner's side, moving away from the CISO, much more towards operational risk management and the CRO typically.
Interesting. Okay. And Rachel, for your insight, what from your perspective is the role of cyber insurance within an industry? Is it a transfer of risk? Is it one of many mitigation techniques that the companies are using? What's the purpose of it within an organization?
So thank you very much, Hubert. And again, a loaded question in that sense. In terms of, I guess, the purpose of cyber insurance per se it is part of the solution, but it also needs to be, when I say it's part of the solution, companies, whether that's large corporates, SMEs, etc., also need to take care and have good cyber hygiene, be mindful of where their own risks are, for example, and then complement that, for example, by having certain cyber insurance policies. In terms of, Patrick mentioned about behaviours that are being, I guess, pushed by the insurance industry, both at an individual carrier level and also at an industry level. We've seen a move towards, I guess, even more than incentivization of good security practices, but in fact, a number of carriers have publicly said that they make certain security requirements or basic cyber hygiene as at least a minimum standard. Again, sort of preferencing the fact that cyber insurance will help you, but it needs to be, I guess, a collective, collaborative risk transfer option for the individual company. And I think one of the, I guess, challenges with a number of companies, and this is probably more on the SME side, is to start that discussion in terms of what they want, what they need, and what services, for example, what is their, I guess, crown of jewels in terms of data, in terms of systems, etc., and to have that opened collaboration, not just with insurers, but also bringing in security professionals like Patrick and others.
And do you feel that a firm's attitude towards cyber risk is ultimately going to impact their insurability or even the premiums that they might be paying? Yes,
well, obviously, as the Geneva Association, we don't comment on sort of pricing or what goes into pricing. That's done at an individual firm level based on a number of factors, including, I suppose, commercial appetite, etc. But in general, the more secure you are, the more that you can show your insurer that you're aware of the risk, that you're actively trying to prevent risks, that your security standards are up to date. That's very likely to have a corresponding impact on what policies are available to you, perhaps on pricing, obviously depending on how a firm will or will not do that. Again, we can't comment on that and we don't look at that at all. But yes, it does impact in that way.
And Paddy, have you seen from an operational perspective that an insurance company has in any way influenced how a company is looking towards their cyber risk mitigation strategies? Have insurance companies, in your experience, ever been able to influence actually what a company is doing on the ground?
Well, insurance companies play a really important part. In fact, I was going to be facetious there, but I'm going to let Craig talk about sort of he's the insurer, he can talk about it. Let me paint a bit of a picture, because I think it's quite important. I think insurance has a really strong role. And actually, the Geneva Association, and indeed Dr. Rachel Carter, has written about this, but the function of insurance actually to reinforce good behaviours. around cyber. At the end of the day, follow the money. So what we're seeing is, cyber has been one of these things that's been affecting companies. It's hitting the press for a long time, but it's starting to hit bottom lines for companies. It's really starting to affect companies. More so, it's also starting to affect personal liabilities for D&O, so directors and officers. I'm sure we'll get to that later. And people aren't stupid. You can see the number of what's called this side of the Atlantic group litigation orders. So, litigation class orders on the other side of the Atlantic. And there's already cases where shareholders and others are actually, as well as customers who've had their details impacted, there's a juggernaut of litigation which has started out in the US and has been going for some time. We're starting to see build momentum this side of the Atlantic. And it's all on the case of, okay, who did something wrong? And then, people are looking for their pound of flesh. Now, whether that's a lasting thing or not, it doesn't matter. The important thing is follow the money. So your question was, well, from an operational perspective, what's happening here? Well, if we take a step back and look at the system, there's, those entities, let's call them insureds for the time being. Those people taking out insurance, they're being hit in terms of the severity. So that's how big the impact is, and the frequency, the number of events. Everyone's talking about ransomware, so we'll use that as a trope to illustrate. So, just like if you bought car insurance and you keep having a crash, that your insurance isn't there to sort of give you a free new car or a better car. It's to keep you moving. And if you keep having a crash, your premium is going to go up. The analogy will break down shortly, but we'll use it just for the sake of the story. On the other side, you've got the insurers who are actually sort of saying, well, okay, at this premium, we'll insure you for cyber insurance or driving your car. But they need to know how often these risks are happening, how often they're materializing, and how much money they need to have to actually cover it. More importantly, who's behind them in terms of reinsurers, capital markets, things like ILS, insurance-linked securities, to actually make sure that there's enough money actually around to cover these things. When you're seeing the level of impact and so the severity, and the frequency of impacts increasing on a systemic level, the insurers start to get worried. And what we're seeing is that there's been a hardening of the market. There's scarcity of resources to actually go out there. We've had a period where, notwithstanding as cyber insurance as a separate class, as opposed to something that's packaged with other types of insurance, as that comes out, we've seen it evolve and mature, and there's been great companies like Craig's, who I'm sure is going to talk about sort of how they've shaped things. But that's been a bit of a journey. And during that journey, we've really seen a bit of an inflection point, and that really happened round about, I would say, around about 2015, where all of a sudden people started to get very worried about the severity and frequency. And you had companies such as Aon in 2019. They estimated that by 2025, the global economic loss from cyber events, economic loss, so this is not necessarily all insured, would be about 6 trillion. A year later, last year, they actually reevaluated that, and they said it's going to be more like 2022. That gives you sort of a view of what's going on here. That's not sustainable. Regulators are looking at it. Insurers and capital markets are looking at it, and the insureds are looking at it. And they're realizing that something has to change. And so I think we're seeing a move towards a greater understanding of what that risk is. Now, notwithstanding that there are what's sometimes called ontological confusion, so that the commonality of language between cyber and insurance, and they're both risk management in the end, but there's different language, which again, the Geneva Association's written significantly about, where there's overlap, but also levels of confusion. What's quite clear though is there needs to be better risk management. in the round, or at least better informed risk assessments. And we're seeing insurers really, and brokers actually, who obviously join up the insured and insurers, sort of getting much more involved in that space to actually look at the outside in view. So, classically, entities would be asked, be given a questionnaire, almost a self-attestation kind of view. How good is your security? Do you do patching, et cetera, et cetera? Well, it's getting a bit more sort of involved now, where people actually want to look under the hood and check that. So that's the outside in. And then the inside out, which is actually looking at your exposure. So what can be seen from the outside? What's your attack surface? So you'll hear people, increasingly you'll see in the market now, people are talking about attack surface management to understand sort of where you can build at. And then critically, your third party dependencies. So, at a very simple level, that might be the internet. At a much more complex level, that might be, for example, there are only 4 globally well-known cloud storage providers. If one of them catches or sneezes, we all get a cold, don't we? So it's much more nuanced. I think, I'm sorry for going on for so long, but I think there's one other point which is probably worthwhile bringing out, which is that recognition of a much more focused risk assessment. It really is driving what's called specificity. So it's actually writing cyber insurance for specific sort of perils. So things that might happen, such as a ransomware event or data loss, but also much more specificity around what's actually been insured, whether that's your cloud environment, as an example, or your online profile or whatever. And that's actually driving a lot of special vehicles, so MGAs, as they're known in the market, which are driving out different types of insurance rather than sort of larger standalone or packaged insurance.
Craig, to respond to that.
Yeah, so I think previously, especially in the US, you had a situation where cyber insurance was too cheap and there wasn't enough due diligence done on the level of security. And there was also a big push by insurers to just go out and gain as much market share as possible. And the result was that people were underwriting policies for companies that had little to no security or not adequate security. Now I think that dynamic has changed. And the way that you should look at insurance in general is you should continue to invest in risk management measures until the marginal rate of return from those risk investments starts to decrease or is negative. And at that point, then you use risk transfer to take on the rest of the risk. So I think what we had before is you still had a marginal rate of return from security investments that was positive, and that was the point when people were buying insurance, whereas now they're being forced to retain more risk through higher deductibles and through a higher level of security being demanded of them. And as a result, now we're getting more towards where that equilibrium should be between risk management and risk transfer. So I think that's a really important point to bring out. I think the other major thing to kind of consider is, yes, we are bringing up the standard. I don't think it's for us to necessarily determine what that standard is. It should be the tech companies who say, yes, I'm Microsoft. I think all admins who are logging into Azure should do so with MFA. And then it's for us to then say, okay, we see that standard and we are going to enforce that. We're going to ask you to maintain that. And indeed now, good security isn't just a nice to have. It won't impact premiums necessarily because it's a prerequisite. So, and that prerequisite is going to differ depending on the size of the entity. So for a smaller company, if you're using G Suite, if you've got MFA turned on and you've got some sort of backup, probably in the cloud, then you're pretty much golden. You've taken care of the majority of your exposure, and the marginal rate of return from any further security investment wouldn't be warranted. So then you can risk transfer out the rest. Whereas for a multinational, then you would be expected to potentially have a SOC of some kind, a robust monitoring and detection capability, as well as the ability potentially to actually restore your systems quickly after an incident as well. And then once you've got those measures in place, then you could transfer off the rest of the risk.
Understood. And just talking to Paddy's point around the fact that obviously a lot of these businesses are using similar technologies, and if one is vulnerable, then it makes a lot of people vulnerable. Surely insurance have to manage their risk pool in the same capacity as well. So are there enough insurers out there offering products to cover all the businesses that are using these technologies?
So it's not a question of is there enough businesses, but is there enough capacity? So even there's a lot of good cyber insurers out there who pay attention to detail and are doing the right things, but they just simply cannot find enough capacity because it is aggregating too much. There is too much systemic risk. So one of the big scenarios that's run by a lot of insurers revolves around a vulnerability in Windows 10 being taken advantage of by some sort of worm that then wipes all those systems. So something sort of akin to NotPetya, but just maybe on steroids, we can say. So there's a lot of disagreement about what exactly that looks like, how many companies are going to be hit as a percentage, or what that sort of impact might ultimately be to them, and how often that event is going to occur. But beyond that, I think the metrics that, well, the overall scenario is probably the same throughout the industry, more or less. And obviously, given the number of companies that are using Windows 10, there's immense downside there. And we will get to a point, or we're getting to a point now, where some insurers have reached their maximum risk headroom. So in many cases, like Hiscox, we say how much we're willing to lose from a systemic event, whether it be a windstorm hitting Miami or a cyber event. And at some point in the future, we will hit that maximum threshold of how much we're willing to lose and how much risk we're willing to take on. And if there's no more reinsurance capacity out there in the market, we'll probably hit that number sooner rather than later. And that's the same as many of my peers out there too. So it's fundamentally an issue about is there enough capital out there to actually deploy? And obviously the next question is, well, what can we do about it? And in other lines of insurance, what's been happening is you have ILSs, as Patrick mentioned, or cat bonds, which basically create a financial instrument to then have an investor take on that downside from a massive systemic event, and in return you give them interest payments, more or less. But for cyber, I don't know if that's actually going to work, because basically to make it work, you need a big financial investor, like big institutional investors, to take on that downside. Yet they're already exposed silently to large systemic cyber events. So if you have a mass cyber event, you'll probably have potentially some sort of economic recession, which may then cause a bunch of mortgages to default. So they might not want to take, or the regulators might not want a bank to take on that sort of downside because it's already there, they're already holding it. So that sort of securitization of risk might not be an option. So then the other option is just eventually we might get to a point where, yeah, we're going to continue to give that risk or give cover for that risk, but only to certain people. And everywhere else, we'll give an exclusion on the policies to negate the possibility of that coming through. We already have that to some degree with things like war exclusions, which at some point would offset the risk. But for me, when I'm looking at our aggregation scenarios, I don't know at what point the war exclusion is going to come in and save my bacon, I guess. So that's the point of kind of uncertainty in the market right now.
And Rachel, just to add to that, I know you've done quite a lot of work around kind of looking at the tail events within insurance and the different collaborations that potentially should be or could be seen between both private sector companies, but also the public sector as well, and ensuring that there is enough capital there to a certain degree to increase the coverage or to ensure the coverage is available for these companies. What are your thoughts on it?
So thank you, Hubert. And I guess this links back to directly what Patrick and what Craig said in terms of, I suppose, what is a tipping point? It's becoming clearer that for some systemic events or for aggregation, as we're learning much more in depth, what that will mean, not just for an individual carrier and or a market, but also where there's, for example, systemic risk across a variety of insurers and or reinsurers. We've heard about ILS, cat bonds, etc. At the moment in the cyberspace, there's not a lot of additional capital that's been available to create cat bonds and or ILSs. From my understanding, I don't believe that in the near-term future that there will necessarily be an influx of capital to create those alternative risk solutions. So therefore, I suppose the question then is really holistically as an industry, at what point can we ensure insurability? And we've heard points about sustainability, about capital adequacy, etc. And I guess at that point, we're starting to look at, is there potential scope in certain jurisdictions, for example, to create a public-private partnership? At the moment, we don't have any public-private partnerships specifically for cyber. There are some terrorism pools that, for example, cover cyber terrorism, but it is, I suppose, a step forward and that would have to be, I guess, at a sort of on a challenging note, that would have to be done jurisdiction by jurisdiction, because if we're going to get the public sector and the government involved, from my experience of working sort of with pooling, etc., I don't believe there's any, I guess, desire for governments to, for example, offset international risks. Rather, if there was a pool, that it would be jurisdiction by jurisdiction. So again, in the short term, that might create some solutions. But it's in the shorter term, it's more likely to create solutions if there was an event which is reactive. But what I guess we're looking at, and what the industry collectively is looking at before we have that event, is there a point where the insurers say, no, capacity has reached its limit, there are no other financial instruments? And I guess at that point, to what extent does the victim, I suppose, suffer the losses beyond what's not available in terms of policies? And or do we see a situation such as, for example, we've seen with COVID, where the government creates ad hoc solutions? And that's really, I guess, a challenge at the moment to fine tune exactly what that balance is, what the capacity and the willingness of various governments. The talk about public-private partnerships has obviously come to light, particularly in light of the pandemic, but there is also fatigue in terms of governments have been handing out and providing funds for pandemics. At the same time, we've seen an influx of natural catastrophes and other types of events as well. So I'm not sure, jurisdiction by jurisdiction, what I guess what the position is across the globe or across the various jurisdictions. But the key thing is that the discussions are starting to happen, that the dialogue is starting to happen, industry, government, and also others. So security providers, those that know the technical ins and outs, and there needs to be that collaboration holistically and, I guess, openly, which in itself brings challenges because of obviously the nature of cyber risks as well.
Okay, no, that's really interesting. And I certainly take your point that bodies are fatigued rather at the moment for having to put out various chunks of money for different events, and is cyber going to be one that's going to appeal to them for wanting to cover in some capacity as well? But I certainly think it opens up quite a wide remit of discussion with different organisations to consider those. One question that I want to come back to just before we move on to touch on some of the other elements is the point that you made, Craig, about the tipping point between the quantifying the risk reduction and the impact on the bottom line for businesses. And that's one of the key challenges that organizations face is really determining that tipping point. From an insurance point of view, is there any ways, methodologies, or quantifiable ways to try and work that out?
Yeah, so I think at the base of any kind of pricing equation is how much is something going to cost versus how often is that going to happen, as Patrick alluded to. So I think that should be the basis of any sort of discussion. So you should know what your downside is if an event happens. So for example, if we're talking about a larger entity, if you want to assume that if somebody's in your network for more than a couple hours, what damage would they be able to potentially do? And you can map out that potential severity. And then you can then use industry data to then hopefully find out what the frequency is likely to be from that. And then you can then potentially map out the difference between, okay, if I catch them sooner rather than later, then what's the difference in that severity? And you might say that, okay, if I catch them right away, it might cost me 100K. And if I don't catch them, it might cost me 10 million, something like that. And then you can then see what's that ROI look like, and then at what point should I be retaining that risk versus potentially handing it off. Again, it's not perfect, but if I was to go about it, I think Patrick will probably be able to tell you a bit more, but that's how I would personally think about it.
I think you're quite right, Craig. But I think you're quite right. I mean, it makes complete sense from first principles, but there's a couple of things that just make it slightly more difficult, I think, in the cyber insurance space. Firstly, there's not really a good rear view mirror to look through lots of data, and it is a big problem that's been raised, just that ontological challenge, and sharing data between sort of insurers and cases and common ways of talking about that data. So common language. The second thing is, it's pretty hard, or it has been in the past. It's trending down. It can be really hard to actually look to see who's in your networks, and actually if you're going to have a breach because they're in your networks or someone else's in the first place. So Verizon, I think it's Verizon, have been putting out sort of this metric. It's called dwell time. So how long, what's the longest period an attack has been inside a network before it's been, discovered. I remember when I first started looking at that, the mean time was something like 260 days. That was about 4 or 5 years ago. And there were cases of, somebody being on the inside for over, well over 2 years, which kind of begs the question, hadn't they swapped some of their IT? I mean, but notwithstanding. Now that dwell time, i.e. how long somebody's been inside a network, is coming down, as I think from a practitioner's perspective, and it does come into insurance actually, some of the new sort of ways of doing insurance. I think that dwell time is coming down as people invest more into detection and response, not just, if you like, building the walls, but the analogy would be having the guard team to actually look around and then actually do something about it if they spot something out of order. And you are seeing a lot of insurance products actually combine those ideas. For all the challenges that Rachel, Craig, and myself have alluded to about liquidity, actually there's loads of opportunity. This is the type of thing that people in the financial markets look at and go, wow, this means opportunity because of all the risks. And they have been highlighted, most notably in the UK, by the Bank of England, and the 2019 cyber stress test. It was actually a vignette. So it was a small stress test as part of a wider systemic review. And it pointed to, the issues about liquidity. It actually launched a lot of activity, and you'll see some really interesting people or interesting ways of looking at this challenge to help insureds, but also to make sure that there's liquidity, and actually perhaps even do insurance in a different way. You've seen, there are people like Akenova and even JP Morgan and others starting to get really heavy into the cat bond and ILS space. It's quite interesting. I don't know whether that's because they've suffered risks elsewhere and they're trying to transfer their exposure, but they are getting in there. They see an opportunity. So that is one statement just about liquidity at the back end. But you're also starting to see different ways of insurance even being written. So classically, insurance would be an indemnity insurance. So you've had a loss, you pay for it. We're now starting to see something called parametrics, which are much easier to actually turn into cash. But you should always be aware you're never going to get 100% back. Insurance isn't there to pay for everything. It's to keep you going. And typically for losses, if you have a loss, it's typically around about 78 to 82% of costs that will be covered. That's anecdotal. I think Geneva Association, ENISA and Akenova actually have written significantly on that. One of the questions I want to understand is, there was something put out by the DCMS last year, which said that, the department, for CMS, the Culture and Media Studies, or Media and Sport, that outlined that of all the companies, SMEs actually hit in the UK, only 80% by a significant and material cyber event, only about 80% of them actually had cyber insurance coverage. I think there's something to actually ask ourselves, why isn't there a greater uptake? Is it because, those entities don't see value in the insurance products they're seeing? Is it because value can't be transferred across, or because risk can't be transferred across? I find that really, that was in 2020, by the way. I find that a very interesting kind of anecdote when we're seeing so much press about cyber insurance and we're seeing so many entities being hit. Why isn't there more of an uptake at the moment?
Craig, any thoughts on that?
Maybe just first to challenge or just to put some nuance around the 76% figure. So I think usually that's probably driven a lot by business interruption cover. And as many companies will have discovered during COVID, you don't just get what your revenue is, you get what your gross profit generally is. So you deduct the fixed expenses the variable expenses. So if you're making bread, well, you won't pay for the flour that you haven't used up, for example. So that might account for some of that difference. In terms of the uptake, yeah, I think most corporates, larger entities over probably 100 million in revenue now have some cyber insurance at least. There's some that are now not insurable because of their level of security and the capacity constraints in the market, but that's another subject. I think SMEs, smaller businesses, a lot of them are probably a bit less aware or skeptical potentially. I think that's probably the main reason for it. They probably haven't been hit, or they think, yes, I've done what Microsoft has told me to do. But they're not necessarily thinking of that black swan event when everything goes to hell in a handbasket. So I think that's potentially, we need to kind of communicate better around what is the maximum downside that those sorts of entities suffer. And again, though, there is quite a lot of marketing material that we put out, that other insurers put out, about what companies like that suffer of certain sizes, even small companies, and how much that's likely to look like. So potentially it's just a matter of asking those companies, are you comfortable with that downside or not? But one issue that I do think is out there is brokers in particular. There's some brokers that are great and have put together specialized teams for cyber, but there's others that don't typically understand the risk as well as they probably should, or potentially need a bit more education. And I think that might change in the coming years. You've got, insurance is an old industry. And I think there is a generational divide there probably. So I think in the coming years, you might sort of see a new, more tech savvy sort of workforce enter, and that might help to change that to some degree. But some of the more traditional older broking houses, I think definitely are suffering or struggling to communicate what that downside actually is in some cases.
Understood. So moving on to some of the key questions that I've certainly seen been raised prior to this is, how confident can companies be that if they are taking out cyber insurance, they are going to have the coverage that they believe that they're buying into? There are obviously exclusion clauses in most products and so on and so forth. But what are the roles of those exclusion clauses? Are they really there to exclude these black swan events or these uninsurable events, let's say, or are they there to give the insurers a bit of an out when there's pressure on the liquidity, let's say, of the market too?
So just to give you an example of some of the exclusions I've recently put into my policies, or that we're putting in across the board, just to add further clarification. So there's always been some sort of natural events exclusion within cyber policies. Now we're adding solar flares to that to kind of further emphasize that fact, because that is an event that would impact basically, if it hit the Northern Hemisphere, a large proportion of our economy. And that would lead to mass data loss, which would then trigger a bunch of GDPR requirements and so forth and so on, and business interruption. So that isn't something that we can really cover. And that's almost akin of a meteorite hitting the planet. And that is the sort of thing that we want to exclude. I've also put in the inversement of the magnetic poles as well. I'm not exactly sure how that's going to impact computer systems, but it sounds a bit scary. But then beyond that, though, the other sorts of incidents that you're likely to have excluded are, so you've got an infrastructure exclusion in most policies, which excludes incidents relating to ISPs, so internet service providers. So if they go down, the internet's non-existent, basically. And you've seen this with DNS in the past. So Dunn, the DDoS attack against them a few years ago, that would have been excluded under most policies, because again, that's just the fundamental internet itself. It's not something that we can really regulate or kind of actually break down into different components. And I think that's the main thing about cyber. If it's something that touches everything all at once and not just kind of one system, then that's kind of where we have to draw the line. Again, the war exclusion, that's an interesting one as to when it would actually be triggered. But I think most people sort of accept, yes, okay, fine. If we do end up in a situation where the FBI or the UK government says, yes, this was actually Russia, then we should potentially pull that exclusion. The other one that's been coming in recently that is a bit new is wrongful collection of data and wrongful use of data. So this is one that you might think is a bit unfair, but I think it doesn't really fall within cyber, because cyber isn't meant to kind of cover your negligence in the way that you carry out your business. So if you're collecting somebody's data for nefarious marketing purposes, it shouldn't be there to cover that. It should be there to cover you if there's a data breach and to get you back up and running. And I think this exclusion is more just helping to offer a clear delineation between where does professional indemnity sort of sit and where does cyber insurance sit.
Rachel, is there anything you can add to that from your perspective?
Yeah, no problems. I think the key thing is in terms of exclusions, they're not there to catch someone out per se. The value add of exclusions and terminological clarity, and that's up to each individual commercial player to create clear language. And I think there is a lot of efforts being done individually and at an industry level to make sure that it's very clear what is and what isn't covered. So that kind of basically creating the fence around what's covered and what's not, and then being able to explain that quite clearly and quite carefully to the insured. I think if an insured knows at the outset that certain things are or aren't covered with I guess in no uncertain terms, or with where it's black and white, there's going to be less problems at a later stage where there's misunderstandings about what is and isn't covered. It's obviously a duty on the insurance industry to help make individual policies at a carrier level clear, to be able to communicate them. That's also the responsibility of the insurer, the broker. Again, we heard about clarity in terms of language. So we're talking apples and apples, not perhaps using terminology which is so different that it may confuse an insured. At the same time, we do need to be cognizant that an insured also has to take care as well. You know, particularly if we are dealing with large commercial entities, they have their own teams of lawyers, of practitioners, of security advisors, etc. So again, it's a perhaps misunderstanding of language. The onus is on both parties then to confirm at the outset what is and what isn't covered. In terms of the exclusions, the Geneva Association and IFTRIP, which is the pool of terrorism pools, have just recently done a 3-piece research project on the war exclusion and also what we call as hostile cyber activity as well. And that was just one example where the industry thought, let's work together and let's create as much as possible clarity in what is or isn't covered. Because ultimately, as long as the insured knows where the boundaries are, there's less scope for litigation at a later stage. And I mean, ultimately, if there is litigation, it doesn't help anyone. It's not a position that a carrier would want to be in, or the industry. We want to create products that deliver on what they promise to deliver. And again, that clarity and that certainty, but it is a two-way street. And I think a big challenge is there's almost sometimes some insurance bashing in the sense, if something isn't covered, then the question will be, well, why wasn't it covered? Whereas it needs to be a balance between the insured asking what is covered, making sure that they're aware of their own policy, and any limitations, sublimits, exclusion, etc. And also the insurers to explain that as well. And I suppose beyond the insurance industry, it's also a broader piece of education in terms of individuals, SMEs, regulators, etc., about what insurance does or doesn't cover, about any potential limitations, etc. Because again, we need to be careful of liquidity. We need to be able to help those and pay out on a policy when an event does happen.
Understood. And Patrick, do you see that filtering down to the operational side of things?
Yeah. I mean, I think, Craig and Rachel have pointed out some, really meaty things as far as exclusions concerned. And unless you're Facebook and Instagram, you're not going to worry too much about your DNS, GRP protocols going down, the internet going down. Not that that happened to them recently or anything. I think from my experience, just sort of first-hand helping entities, I think a lot of those exclusions are it's common sense now. I think, the journey in terms of maturity where those insurance policies are, having seen them, 5 years ago, 140-page document, it's pretty weighty. It's not easily consumable. I think they're much more consumable now. The language is much clearer and those exclusions are straightforward. But unless you're a policy waller or working for systemic risk at government or at sort of cat bond level, a lot of that's not going to be pertinent to our audience here. Where things really fall apart is actually the interpretation of those insurance policies actually when it happens, and that's usually around expectations. And I think that's just usually a level of familiarity between the insured and the broker actually understanding what's in the insurance policies more than anything else. I do think the insurers sometimes get beaten up. Just to illustrate a little bit, it's all about expectation, and how many times have I helped a client where they've, we've had something, we need to buy the latest, greatest widget to come in and actually put a hole in the gap. Well, that's viewed as betterment. And that is clearly outside. Actually, those insurance policies are there largely, unless you've got a really antiquated bit of kit to get you back to where you were before the event. They're not there to pay for extra. They're not there to better you. And that's an area that lots of people sort of, particularly when you have, maybe the CRO or the CFO is owning the insurance policy and that whole sort of debate. You've got a separate team doing the instant response and the CISO. They don't always sort of see eye to eye, and that's typically like an area that I'll get involved in. The other big one that I'm seeing is just where does responsibility come down to? So typically, let's say, Hubert, you have a breach, you trigger your insurance policy. Hey, Craig, I've had a bit of an issue. I need to trigger it, and you have to do it quickly because if you don't on indemnity, you could be in trouble. So Craig hooks up his response team. You'll have a forensic IT guy that comes out, will help you. You'll have a PR guy, and you'll typically have a lawyer as well. So it's usually sort of three-man team, typically operating under legal privilege, i.e. the law firm sort of taking over and sort of shaping things. That all works perfectly in essence. And certainly, Craig's team, I'm sure, will do a fantastic job. But the amount of cases where you see those sort of three teams come in, they don't necessarily see the same situation. They don't necessarily have the same incentives always, just from a very practical level, nor do they actually see some of the downstream risks. So they were there, the scope of their activity is to triage the event, to respond to it, and to help you recover. But they're not necessarily looking at the downstream risks. Granted, the lawyer will be thinking about regulatory, but they're not always thinking about some of the commercial risks, nor are they thinking about some of the litigation that might be coming down the track. And especially if it's actually been a third party that's been affected, that is actually the egg's on you when it's your service provider or somewhere else. That's a typical case where, alongside the insurance team, working with a general counsel, I'll come in to actually sort of give independent advisory, independent coaching, work with them, make sure that there's a level of good understanding with the insurers to head off any of those betterment issues very early, to give clarity to the insurer and the loss adjusters as to what's actually been impacted and what's going on about it, to make sure some of those downstream risks are managed. That's the area where I think there's most sort of confusion, and it's all around expectation rather than anything about exclusions in policies.
Thank you. I'm conscious of time as we're coming to the top of the hour, but one thing that I do want to cover off just very briefly before, because there's a few questions around, is around the ransomware side of things, because we've seen certain changes in the insurance industry. Some are starting to not insure it, as we're seeing in France, so on and so forth. Craig, what's your take on whether ransom should be covered, should be paid, and so on and so forth?
Yeah, so at least when I look at my operations in Hiscox Europe, we demand a very high level of security, or a relatively high level of security from our clients. As a result, most of the time we can get away without paying a ransom. And that's shown in the fact that last year, out of all the claims that we paid, all the money that we gave out to reimburse clients for losses, only about 5% of that went towards the reimbursement of ransom payments. So I think that strategy is working. So for me personally, there is going to be some situations where if you don't pay the ransom, that business is going to be up the creek without a paddle and potentially become insolvent. All those employees are going to be unemployed after the incident potentially. So I think there is some limited instances, provided that they had good security in place, where it may be warranted paying a ransom.
Rachel?
I think ultimately it needs to be a decision made at a carrier level. So each individual carrier needs to decide whether they pay or whether they don't, and what, as Craig has said, what the terms and conditions are, because generally with ransom, there's not necessarily a black or white solution for all cases. I mean, we have seen some cases where, for example, a lady died as a result of some hospital equipment going down. And in that case, that brings in, I suppose, other challenges, moral and ethical challenges. Again, need to think about what systems are in place as to whether it would be suitable and or not in those particular circumstances, if there's sufficient backup and if the security level is sufficiently high. It's obviously advantageous not to pay a ransom in general, but again, a case-by-case basis. And in terms of the Geneva Association, just to clarify, we don't have a position on ransomware. Some of our members publicly admit that in certain circumstances they will pay a ransom, and some of our members publicly say that regardless of the circumstances, they won't pay a ransomware. So we don't have an industry position per se.
Understood. Paddy, something to add on that briefly?
Yeah, briefly. I think firstly, there are already legal constraints about paying ransomware, or at least there are prescribed entities under EU, UK and SEC law, and they have existed for some time, and actually that group is growing. Okay. The difficult bit is actually, can you attribute to prescribed groups that might be behind ransomware or not? This is made more difficult because a lot of ransomware is now franchised. So it's not one group. It's not even a software. When you say ransomware, are you talking about the ransomware gang? Are you talking about the access group? They're actually gaining access, the guys that are extorting, or the guys that are pulling through stuff at the end? Or are you talking about the software? You could be talking about lots of different things. Ransomware as a phenomenon is just franchised now. And actually the case that Rachel brought out, the manslaughter case, the first one that was associated with a ransomware event, actually happened last year in Germany, where a less professional, let's put it like that, and I do say this as a practitioner, but the franchise was far less professional than I'd seen sort of, 2-3 years ago. Basically a bunch of cowboys, ransomware as a service. They actually targeted the wrong hospital, or at least they sent the ransom note to the wrong hospital, which caused a raft of issues. It's a manslaughter case, and that is actually going through the German courts at the moment. Whether you can attribute that and to what degree to the ransomware event or not, I don't know. Whether you should pay or not, there are huge differences both in time and geography. In the States, it was, 80% of the time, insurers would be going, yeah. As a Brit, you kind of gall at that, or at least I did when I was sort of knee deep in it a couple of years ago. You're a bit squirmish as a Brit, sort of saying, should we really pay? But it was the norm. I think that's changing. I do think that's changing. I don't think there has been the same norm this side of the Atlantic. I think actually there's also a different sort of moral impetus behind that. I won't go on too much, but actually when you start getting into the negotiations with these groups, that's when it becomes really fascinating. You can tell how serious they are. even when you do pay. And it can be different for different organizations. If you're running an MSP, every second counts. And you're on the phone to the CEO, every second counts, and the number that was originally, that pales into insignificance compared to the world of pain he's going to get from his shareholders, etc. But actually engaging with those ransomware entities and how you negotiate, it's a fascinating and separate conversation.
Thank you. We reached the hour, and I'm conscious of all of your times as well. So we can bring a pause to the proceedings here, and if there are any further questions, then people please do send them across, and we can put them to the panelists over the course of the next coming weeks. But Craig, just to sign off, if anybody does want to follow you for any more thought leadership and insights, where can they find you?
Just on LinkedIn. I'm relatively not very present on social media.
No problem. Rachel, if people want to follow you for more insights.
Yeah, so 2 places, LinkedIn for my personal information and personal thought leadership. For any work that the Geneva Association has published, that's freely available to download off the Geneva Association cyber aspect of the website.
Thank you. And Patrick?
Yeah, there's not many Patrick MacGloins on Google. You'll find me on LinkedIn and CSEC and a couple of other places. Always happy to speak to interesting people, as I have done today.
Thank you very much indeed, all of you, for your time. Really appreciate it. Thoroughly entertaining conversation, and hopefully raised a lot of talking points within businesses as well. So thank you very much indeed, and look forward to speaking to you all again.
Thank you very much.